Adobe stock is down over 65% from its all-time highs. One of the most dominant software businesses ever built, trading at a massive discount. The market is terrified that generative AI and competitors like Canva are going to destroy Adobe. In my view, the market is overreacting to the noise and missing the fundamental strength. I'm Edward Kalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're analyzing Adobe through our 5 key factors: economic moat, return on capital, growth, financial strength, and valuation. Let's start with the moat. The moat is the most critical factor, and with Adobe, this is where the real debate is happening. I want to be upfront. Morningstar recently downgraded Adobe's moat from wide to narrow, citing the rise of Canva and Figma alongside AI uncertainty. Their moat assessment is built on switching costs and the logic is solid. Once Adobe's tools are embedded in a creative professional's or enterprise's workflow, replacing them is genuinely disruptive. Their software migration costs, employee retraining, operational downtime, and real productivity loss during the transition. On top of that, because nearly every creative professional uses Creative Cloud, everyone else has to as well, which hints at a network effect layered on top of those switching costs. And then there's Document Cloud. Adobe invented the PDF format. Acrobat has been the gold standard for over 30 years, with no credible challenger in sight. Now here's where I diverge from the bear case. The market is treating AI as an extinction event for Adobe, but I see no sign of this unfolding. Firefly has generated over 29 billion images, and AI-related ARR tripled year over year to over $400 million. Adobe isn't being disrupted by AI, it's monetizing it. The moat is narrower than it was, but that doesn't mean there's no moat. And right now, the market is pricing it as if there's no moat at all. Now the moat analysis you just saw, I pulled it directly from Fiscal. It's the platform I use to analyze the 5 key factors. If you want to follow along with the same tools, the link below includes a 15% discount at no extra cost to you. Now let's get into the numbers, starting with return on capital. Returns on capital tell us how efficiently management turns investor capital into pure profit. And Adobe's numbers here are exceptional. Return on invested capital is 36% and improving over the past decade. Return on equity is 55.4%, also improving. Now let's compare to peers. For return on invested capital, Microsoft sits at 23.9%, Intuit at 13.8%, and Salesforce at 7.4%. Adobe is the strongest here. Now on to return on equity. Microsoft sits at 33.3%, Intuit at 20.3%, and Salesforce at 10.3%. Adobe doesn't just beat its peers, it laps them. A 36% return on invested capital and 55.4% return on equity with an improving trend means management is getting better at deploying capital over time. That's exactly what you want in a long-term compounder. Consistent growth is the fuel that keeps a compounder running. Without it, even the strongest moat eventually stalls. Adobe delivers. Over the last decade, revenue grew at a compounded annual growth rate of 16.8%. Net income grew at a CAGR of 22.2%. Earnings per share grew at a CAGR of 24.5%, slightly stronger than net income growth thanks to disciplined share buybacks, returning capital to shareholders. Now let's compare earnings per share growth to peers. Microsoft grew earnings per share at a CAGR of 20.4%, Intuit at 15.7%, and for Salesforce, it's not computable from 2016 due to negative earnings in that year. But from 2017, their earnings per share CAGR was 38.8%, which is exceptional. Adobe shows solid growth. The bears argue growth is stalling, but the most recent data shows revenue grew 12% year over year, beating guidance for the 7th straight quarter. Management expects growth to re-accelerate in the second half of 2026 as their AI initiatives and new products like Adobe Express further expand their user funnel. Financial strength is our sleep at night factor. Adobe's balance sheet is exceptional. Total cash and cash equivalents sit at $6.6 billion and total debt is also $6.6 billion. Let that sink in. Adobe can cover its entire debt load with cash on hand today. Total free cash flow is $9.9 billion, which gives a free cash flow to total debt ratio of 150%. That is an extraordinary level of financial flexibility. Adobe isn't just surviving, it's generating nearly $10 billion a year in free cash flow that it can reinvest, buy back shares, or deploy into AI development. This is a company that is built to win in any market environment. Even the greatest business can be a bad investment if you overpay. Valuation is the final filter for our margin of safety. And right now, Adobe's valuation tells a very interesting story. Forward price to earnings is at 10. To put that in context, the historical median was around 31, the historical maximum at 51.7, and currently, it's near the lowest level since 2017. The market is pricing Adobe like a business in permanent decline. In my view, that is a fundamental mispricing. But let's go one step deeper with the price to earnings growth ratio, because this adjusts for growth and it's the most honest valuation metric for a compounder. The forward PEG ratio based on long-term earnings per share growth estimate of 13% is roughly 0.8. A PEG ratio below 1 is generally considered undervalued territory. Adobe is at 0.8, paying less than fair value for the growth you're getting. In my view, Adobe is significantly undervalued. The market is pricing in an AI apocalypse for Adobe. I'm pricing in a business that has survived and strengthened through every technology shift for 40 years and is actively embedding the next one into its core product suite. Let's bring this together through our 5 key factors. Adobe's moat has narrowed by competition, but is reinforced by deep switching costs and AI integration. Returns on capital are best in class, with 36% return on invested capital and 55.4% return on equity. Growth is exceptional at 24.5% earnings per share CAGR over the last decade, driven by consistent execution. Financial strength is at fortress level, with cash on hand covering total debt entirely. With a forward PE ratio of roughly 10 and a PEG ratio of 0.8, Adobe is undervalued. In my view, Adobe is one of the most undervalued, high-quality businesses in the market today. The market is treating a temporary period of fear like a permanent impairment. Are you following the panic or the opportunity?